Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
We have a free 2-week trial offer. If you just go to this link here, you can get a 2-week trial and look at our Currency Professional, our subscription service that we do every day. We also have a Currency Investor monthly service. I think it's just $49 a year. It's pretty, for 12 issues, and we give recommendations on ETFs in there. As part of the Currency Professional, you get the Currency Investor monthly. We have just started the Managed Forex program, again, just getting that underway, and you can find some information on our site. And we also have a free currency if you don't get that, that you can sign up daily. And that's it, Steve. Thank you, and I'll take some questions.
Jack, thank you very much. So what's the best way to sign up for that free trial? Is it to go to your site if they don't have that link?
Yeah, they can find it on our site, free trial.
Perfect. All right, Jack, why don't we go through the questions here. Let's see. Here's one. Chuck says, how will commodity prices be impacted by QE 1, 2, 3? I'm adding 4, 5, 6. I think you actually alluded to a lot of this, correct, Jack?
Yeah, it just depends on whether or not it works. If the game continues, QE out to infinitum, pumping money out into the global economy, and everybody continues to take that money and accept a weaker dollar, commodity currencies keep going because the music keeps playing in the emerging markets where most of the commodity action is played. So, but if QE2 doesn't work and people start to say the expectations of the QE2 are way overdone, we're not seeing a rebound in the real economy in the U.S. or Europe, and won't see for a while. We think risk assets come back in a big way pretty fast, and that clobbers commodity currencies. So the jury is very much out.
Yes, that's true. Obviously, one day we think there's deflation, and the next day we're worried about inflation. It's very strange. TJ has a question, Jack. I'm sorry, this question keeps scrolling. Even if the U.S. dollar bounces back, but as inflation is expected, will commodity currencies maintain their value as well as the equity market? What do you think, Jack?
If the U.S. dollar bounces back and there is some type of implicit agreement, and we see China normalizing, becoming a real economy, as opposed to the hermit economy that they are, then we think global growth continues and demand returns. We think the commodity currencies will trade just fine in that environment, absolutely. But one of the problems that we see is there's not inflation in the world, and we think that there could be a massive global deflationary problem because what the Fed's doing doesn't matter. It just doesn't matter. At the moment in terms of creating inflation. So our concern is deflation in a big way. They're using all this dollar credit to try and reflate, but there's still a lot of private deleveraging going on out there, and a lot of holes in a lot of financial institutions' balance sheets that are dead in the water, that are just using this money to maintain themselves and not creating a stimulative environment. So when the money doesn't get into the real economy, it can't push up prices to create inflation. If you create all this money and it doesn't get into the real economy, it's not really money. It's just debits on bank balance sheets. And that's what we think is happening because of the secular change toward taking on more and more credit. And that's why we're very concerned of a global deflation as China pumps out more and more final goods supplies in a very, very big way, and global demand continues to fall. That's in a deflationary scenario, not an inflationary scenario.
Interesting point. Patricia would like you to, obviously everybody has a different definition of long-term, intermediate, and short-term, but she wants to know your perspective on long-term. I guess when you're looking at investing in ETFs or even in the options market, how would you define long-term and intermediate term? We know short-term is spot trading, and that's probably intraday. But
I guess our intermediate term is it's probably several weeks to several months, out to 6 months time, 3, 4, 6 month time frame. And after that, in terms of the currency markets, we consider long-term. Long-term in the currency markets, in our time perspective, is a little skewed compared to regular real investors in other markets. Right. It tends to be different.
We have great questions. Jack, what was your take on, this is just a question for me, the dialogue that was announced to us from G20 over the weekend? What were the expectations going in, and do you think that they met the expectations?
I do. I think the expectations were close to zero going in, mm-hmm. and some people think they were close to zero. But we thought because of the, what they did, the bone they threw to the EMF, and increasing their voting rights in the IMF, International Monetary Fund, and the very, very public voicing by Germany, and Germany being very correct, by the way, saying that the U.S. manipulates its currency by pumping out more and more money. We think those two events, and the fact that although they didn't act on Geithner's idea of targeted numbers for current account surplus and current account deficits, they didn't dismiss it entirely out of hand, and the IMF will be, coming up with some targets. So taken together, we think that had some implications there that were more positive than what was expected. But we just have to see how it plays out. And again, the key is going to be between U.S. And China.
Interesting. Chuck has a question about global currencies. Which ones would be best suited in a deflationary economy? I mean, obviously we were headed there, even as of a month or so ago. If we saw deflation, where would you want to be, Jack?
If we saw a major deflation in the world, I'd want to be in the U.S. dollar. The global reserve currency tends to do well in deflation. As people continue to write down their debts and credit comes in. Dollar-based credit would shrink out there in a big way because the demand wouldn't be there from the U.S. consumer. So you'd see those credits start to pull back in and money just continue to flow from the periphery to the center to cover the debts. All these people that are sending this money offshore in a major deflationary environment, their debts look worse and worse. So even though they had winning trades offshore, they would have to bring that money home to cover holes in other areas that they have, and that tends to be beneficial for the world reserve currency. So the dollar would do quite well in that environment, and obviously, long-term government bonds would continue to do well. Most people think bond yields can't go lower, but they can go a heck of a lot lower if we get into a deflationary environment. And I would draw your attention to these Hoisington Investment Management, Housington, Hoisington. If you just Google them and look at their economic research, their latest report, they do excellent work. Lacey Hunt, excellent economist, talked about this issue precisely and why he thinks long-term interest rates are going to go a lot lower. We are slipping into a deflationary environment.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.